When it comes to the financial markets, 2025 has been a year filled with surprises. Stick with us today as we do our year-end top 10 recap of economic and capital market happenings. Remember to keep in mind that all of the data quoted here is as of business close on December 8th, 2025. And with a few weeks still left in the year, there's always a possibility that things can change before we officially close it out. With that small disclaimer out of the way, let's jump right to it. Kicking off with number 10, and a big surprise for this year is the performance in the metals market. With a weakening dollar and persistent inflation, precious metals rallied significantly and churned out the best gain so far in 2025. With gold closing at $4,203 per ounce, up 61%, and silver at $58 per ounce, up a whopping 100% for the year as of December 8th. Many are pointing to this significant rally in metals as a sign of weakness in the overall economy. Despite global conflicts, there has been downward pressure on oil. Between excess production and decreasing demand, oil prices have struggled to make gains. It does provide some relief at the gas pump, but also headaches for oil investors. As of December 8th, Brent crude is down to $62 per barrel, currently posting an 18% loss for the year. With a mixed bag of data, the housing market remains a pain point for many would-be buyers as the market continues to be unaffordable, with the median home price up 1.3% year over year at approximately $440,000. Conversely, mortgage rates have come down just a bit, with the average 30-year mortgage yield at 6.34%, providing a little relief. Headlines state that this is a buyer's market, with buyers outnumbering sellers almost 2 to 1. However, as mortgage applications are being denied in large part to credit quality, and as buyers are looking for incentives, including competitive pricing, some sellers are giving up entirely, removing their homes from the market. Still, sales are up nominally at 1.7% year over year through October 2025. The labor market has proven to be a drag on the economy in 2025. Even with the government refusing to publish official data for the rest of the year, it is evident that the jobs market is in a downshift. The unemployment rate stands at 4.4% as of September. Although it's tough to know exactly where that rate stands since we don't have the October and November data, we do have some clues about the direction of the labor market. With U.S. layoffs set to exceed the 2008 financial crisis, we have shed 1.2 million jobs so far in 2025. That's up 54% from 2024. It's the highest since 2020 and 2008 before that, with the biggest losses coming from government jobs, shedding 307,000 jobs this year alone. That's something that is highly unusual. Job cut announcements in November alone were up over 70,000. That's up 23.5% year over year. While hires for that same time period were only up about 2,500 jobs. Adding insult to injury, U.S. non-farm employment fell 9,000 in November, marking the second consecutive monthly decline. Thanks in part to tariffs, inflation picked up steam in 2025. Even though we just learned that the Bureau of Labor Statistics will not be publishing the October PPI data, we do know that prices are on the rise. We know that CPI is officially up 3% year over year as of September. Among the categories with the biggest price increases include apparel, food and beverage, healthcare, and housing, putting significant pressure on consumers as they struggle to keep up with some of their most basic needs. Affordability is quickly becoming the new buzzword in the political landscape as candidates leverage the issue to advance at the polls. After a strong 2024 and first half of 2025 returns coming off the back of the presidential election, crypto has taken a significant hit. By July of this year, Bitcoin hit an all-time high of $124,128 and then suddenly took a big churn to the downside in the second half of this year, bottoming most recently in November at $80,659. It has since recovered some of those losses, finishing on December 8th at $91,115, but not nearly catching up to its all-time high. A number of factors contributed to the decline, including macroeconomic concerns and negative sentiment. Ironically, and despite all of the macroeconomic concerns and a legitimate correction in the first quarter, the equity markets climbed a wall of worry in 2025, causing many analysts to make comparisons of this market to that of 1999. Equating the AI excitement to that of the dot-com era, many point to the fact that the Magnificent Seven, as they are called, as the only thing really holding this market up. It's hard to ignore that this might be another tech-related bubble. Despite these concerns, the melt-up in the market has been nothing short of euphoric, with each pullback being supported by buyers who seize the opportunity to invest. As of December 8th, the S&P 500 closed at 6,845. That's up 16.66% year to date. The Dow Jones closed at 47,739, up 12.61% year to date. And the tech-heavy NASDAQ closed at 23,545, up 22.12% year to date, all as of the December 8th market close. Although bonds have begun to make a little ground, there were still a lot of ups and downs in 2025 for the category. Coming into the year on a strong note, bond yields fell in the first quarter as the equity markets were in correction mode. But by the second quarter, we saw this game reverse course. As the equity markets recovered from that correction, bond yields rose, giving up all their returns from the beginning of the year. Since then, yields have come down again a bit, but with the 10-year yield closing at 4.17% as of December 8th. Still, on a year-over-year basis, the bond market is essentially flat, producing virtually no returns. The Fed has been stuck between a rock and a hard place this year. With pressure from the White House, inflation picking up a little steam, and labor market weakness, the policymakers have been walking a tightrope trying to make sure they keep the economy intact without adding fuel to the inflation fire. So far, the Fed has reduced rates by 50 basis points with a 25 basis point cut in September and another one in October, ultimately bringing the target range to 3.75 to 4%. Consensus is that we are likely to see one more 25 basis point rate cut this week, so before the year closes out. And we will likely see further and maybe even more aggressive rate hikes into 2026 since Kevin Hassett is the favorite for the next Fed chair pick. And Hassett is regarded as the most dovish Fed governor. After a minor contraction in GDP of 0.5% in Q1, the US saw a rebound in economic output in the second quarter of 2%. Projections and estimates for GDP in 2025 are at 1.7% annualized growth. That's down from 2024's 2.8% rate, still positive nonetheless. However, with the government refusing to publish Q3 data and likely not publishing Q4 GDP data, it's really hard to know exactly where we stand on this figure when it's all said and done for the year. Whether we entered a recession or not will not likely be realized until the figures are made public once again. So 2025 has certainly proven to be very interesting for the economy and the financial markets. No question about that. Before we sound off, we want to wish you a very joyous holiday season and a prosperous and healthy 2026 from your friends at CFI.